All right, today we're talking about one of the most powerful and, honestly, one of the most overlooked tools for building wealth, the self-directed IRA. Now, if you think your retirement savings are just for stocks and bonds, get ready, because we're about to blow the doors off that idea.
So let me just ask you something right off the bat. Could your retirement fund buy a building? I'm talking a rental property, maybe even a small apartment complex. For most people, that sounds crazy, right? Totally impossible. But it's exactly what some of the smartest investors are doing to build wealth in a completely different way.
Here's how it really breaks down. You've got your typical IRA, which is kind of like a walled garden. You can only pick from the stocks, bonds, and mutual funds that your big brokerage offers. But then you have the self-directed IRA, or SDIRA. And that is a wide-open universe where you get to invest in real estate, crypto, private startups, you name it.
Okay, so how does this actually work? Let's dig in and see what makes an SDIRA such a game changer compared to the path you're probably used to.
And first things first, let's clear up a huge misconception. An SDIRA isn't some brand new, legally separate type of account like a Roth or a traditional IRA. Think of it more like a special designation. It's you telling the IRS, hey, I'm taking the wheel. I'm taking the driver's seat on this, and you're going to be the one directing your investments. So if you're in the driver's seat, what does that actually mean? Well, a special custodian holds onto the assets and handles the paperwork. But, and this is key, they give you zero investment advice. I mean, zero. You're the one finding the deals. You're the one doing the research, and you make every single call. It is total control.
So why is this such a big deal? Well, get this. There's about $15 trillion sitting in U.S. IRAs right now. Trillion with a T. And almost all of it is just parked in Wall Street products. Basically because the big brokerages say offering anything else is just too much of a hassle for them. That's a mind-boggling amount of capital that could be doing so much more.
All right, now for the really fun part. With all this control, what can you actually buy with this thing? Let's go explore the investment universe that an SDIRA opens up.
You know, the IRS is kind of backwards on this, but in a good way. They don't give you a long list of what you can invest in. Instead, they give you a super short list of what you can't, like life insurance and collectibles. So that leaves pretty much everything else on the table. We're talking rental properties, Bitcoin, a stake in your friend's startup, gold bars, even making private loans. The whole point is to let you invest in what you know best.
Let's make this real for a second. There was one investor who used their Roth SDIRA to buy a property for about $4,600. Just a year later, they turned around and sold it for $20,000. And that profit, over $15,000, was 100% tax-free because it all happened inside their Roth account. Now that's putting this strategy to work.
But, and this is a huge but, with all this incredible power comes some pretty serious responsibility. The IRS rules are not suggestions. They are absolute, unbreakable laws. So it is absolutely critical that we cover the rules you have to follow to the letter.
Okay, if you only remember one thing from this entire explainer, please make it this term: prohibited transaction. It's basically any deal that improperly benefits you or what the IRS calls a disqualified person. Think you, your spouse, your kids, your parents. The logic is really simple. Your IRA gets all these awesome tax breaks, so you can't personally benefit from its assets until you actually retire.
And believe me, these rules get super specific. You can't buy a house from your IRA, and you can't sell a house to it. You can't go stay in your IRA's beach condo for a weekend getaway. You can't even fix a leaky faucet in a rental property yourself. That's called sweat equity, and it's a huge no-no. And you can never, ever, ever mix your personal money with IRA funds, not even for a minute.
So, what happens if you break one of these rules? The penalty is, well, it's catastrophic. This isn't a fine. It's not a slap on the wrist. If you make just one prohibited transaction, the IRS considers your entire IRA liquidated, cashed out on January 1st of that year. You will owe income tax on the whole thing, plus penalties. A single mistake can wipe out decades of your hard-earned, tax-advantaged growth.
Okay, I know that was intense, but you have to know that stuff. Now that we've gotten the really scary part out of the way, let's get back to the good stuff and talk about how savvy investors actually use these accounts to their advantage.
So your first big strategic decision is the classic one: traditional or Roth. A traditional SDIRA is great if you're in a high tax bracket now and you figure you'll be in a lower one when you retire. But if you're chasing those high growth assets we talked about, the Roth SDIRA is usually the play. Yeah, you pay your taxes up front, but then every single dollar of growth and every withdrawal you make in retirement is completely 100% tax-free. Now, for those of you who want to get really active, there's a pro-level strategy called checkbook control. Here's the gist. Your SDIRA creates an LLC that it owns completely. You get named as the manager of that LLC. Then all your IRA money gets deposited into the LLC's new bank account. And boom, you literally have a checkbook. You see a deal you like, you can write a check right then and there. No more waiting around for a custodian to process things. It is the ultimate in speed and control.
But listen, none of this is possible without the right partner. Choosing your custodian is a huge deal, and they're not all the same. Some charge a flat fee every year, which is awesome if you plan on making a lot of moves. Others charge based on how much money is in your account, which might be better for bigger, more passive portfolios. There's no single right answer here. It all comes down to your personal strategy.
So, we've covered the incredible power, the super strict rules, and some pretty smart strategies. Which, of course, brings us to the biggest question of all: is a self-directed IRA actually the right move for you?
When you boil it all down, an SDIRA is really about a single massive trade-off. On one side, you get an unbelievable amount of control and the potential for returns you just can't find in the stock market. But that's perfectly balanced on the other side by a huge increase in your personal responsibility and, of course, risk.
And let's not sugarcoat those risks. The SEC is constantly warning people that these accounts can be magnets for fraud, precisely because your custodian does zero, and I mean zero vetting of your investments. Many of these assets are also illiquid. You can't just click sell and get your cash in 2 days. And like we saw, the rules are complex. The full weight of avoiding scams and bad deals falls squarely on your shoulders.
Really? The whole point of an SDIRA is to let you capitalize on your specific knowledge. But you have to understand, you are flying this plane completely solo. Think of your custodian as the airport. They provide the runway, but that's it. They're not checking your flight plan or inspecting your engine. You are the pilot in command. So, we'll leave you with this. An SDIRA is definitely not for everybody. It demands serious education, serious diligence, and a lot of discipline. But if you have that specialized knowledge, if you know an industry inside and out, and you are ready to embrace all that responsibility, then this could be your chance to take control of your financial future in a way you never, ever thought was possible.